Well, guys, so in essence, what is hedging, right? I grabbed the definition of hedging from Investopedia, right? It's going to be that first paragraph up here. So essentially, portfolio managers, individuals, corporations use hedging techniques to reduce their exposures to various risks. So in a declining market, we want to reduce our exposure. We don't want to suffer a deep hit. Just like what happened in the bear market, right? Going into December, January, that 20,000 high, that 17,000 high, and then all the way down. Anybody that did not hedge their portfolio, whether going into fiat or whether issuing a short, opening a short position early on at that 17,000 mark. A little later, I'll go into how to spot the hedging positions. If you guys are with us, we do this all the time. We're shorting all the time. We're longing all the time. We have a portion of our portfolio dedicated to margin trading, and we're hedging every bet. So no matter what the market does, we're in the gains. Now, hedging against investment risk means strategically using instruments in the market to offset the risk of any adverse price movements. And when I post saying various instruments, I've said that on our Facebook and Twitter several times. People are like, I don't understand what you're saying. What's an instrument? Well, an instrument's going to be a future contract or a derivative. Essentially, anything that we can invest in or put our money in, right, and take a position that's going to protect us from a downturn. It's just another investment vehicle. So in other words, investors hedge one investment by making another, and the other is essentially opening up a short, and that's what we're going to talk about today. I do have a BitMEX tutorial, right? We did a BitMEX workshop. So if you're not familiar with BitMEX, after this workshop, before you get into BitMEX, I suggest rolling through the workshops and watching the BitMEX tutorial, how to short and long on BitMEX. Hedging options in crypto, we literally only have two options. We can either short sell Bitcoin on margin, which is very effective. It's a leverage trade. So we can take a certain BTC value, leverage it up, and I'll cover what leverage is in a bit, leverage it up, and then it's earning 25% for every 1% that BTC makes, or 10% or 5%, however much you want to leverage it. We're essentially assuming more risk in a sense of it's not a hodl, right? If it drops past a liquidation price, whatever margin, whatever amount of BTC we had in that trade, it's going to be gone. The profit loss ratio can be very rewarding, because if we do hedge properly and then the market takes a dip and we're leveraged up, then we're making a lot more percent gain on that trade than we would hedging any other way. Another effective way we've hedged before was finding inversely correlating altcoins. And what that means is coins that would move up in value while BTC was coming down. Some decent hedges that we've had in the past that were really successful were Dash, Ether, BNB, and then there's always Tether, but it's not really a hedge. You're just exiting the market and looking to buy back at a cheaper price. A classic hedge formulation would be buying BTC and shorting an XBT future. Absolutely, Watchman. But that being said, you don't want to buy BTC today and short BTC today at the same price, because that's just very, very amateur. Right? Because if you bought it today, you bought it under the assumption that price is going to go up. And if you're going to short it because you bought it today as a hedge, that's essentially saying you didn't have a good reason to buy. Now, I'm gonna move through this PDF that I put together, and then as I'm going through it, I'll go over your questions. Who should hedge? Anyone looking to outperform the market. So if your portfolio is dropping, you're a bunch of alts, and you're losing a lot of BTC value, Well, if you don't want to go through that again, if you want to go through another bear market of just losing money and watching your portfolio get crushed, you should definitely look into hedging. And everyone that's engaged in margin trading should cover their butts, right? And start hedging shorts whenever the market tells us so, instead of just exiting along, because, oh, I'm up 30-40%. I'm just going to exit the long. No, what this workshop's going to do, it's going to essentially show us the big picture and how we can secure the most gains out of our longs, when the best time to hedge a short is, and set stop losses on those positions so they're countering each other. I'm not sure about what that last statement, Watchman, but the reason is we don't have options that expire worthless. So all options are going to expire except for an altcoin, right? If you're not doing it on margin. All right, short selling, if you guys aren't familiar with short selling, it is the sale of a security that is not owned by the seller, right? Or that the seller has borrowed. But whenever we're shorting on BitMEX, it's more of a CFD, and I'll cover what a CFD is, which is a derivative. But back to short selling is motivated by the belief that a security's price will decline, enabling it to be bought back at a lower price to make a profit. So essentially, whenever we open a short position, whenever we open a hedge, it's because we believe, there's a good reason for us to believe so, that the price is going to come down. That's going to be in the part of when to hedge, right? And we'll go over that shortly as well. Shorting options by exchange. There's Bitfinex allows shorting, Kraken, BitMEX, GDAX, and Gemini all allow margin trading. Some not open to the US. We do have the luxury of using BitMEX on VPN, right? But so that's what I'm really going to go into, since most of us in here use BitMEX. And since most of us use BitMEX, you're familiar with it, I want to cover some of the basics, and then we'll go into contract types, and I'll go into the chart, and just keep the show rolling. You guys have any questions so far about shorting? Some of the newer people that just came in for the workshop. Right, so buying and short selling futures contracts in the form of a CFD on BitMEX. So even though BitMEX futures are futures, they're essentially derivatives because they're a swap. So whenever we put one BTC into BitMEX, it gets swapped for XBT. That's what we're trading. Whenever we withdraw it, it gets swapped back for BTC. So XBT to BTC value is going to be a 1-to-1 swap. And if you want to sound fancy, you can tell your friends, hey, I'm trading derivatives now. Anyways, so moving on, leverage is going to be, it's offered on BitMEX, and it comes in the form of 1x, 2x, 3x, 5, 10, all the way up to 100. If that confuses you, think of X as in your contract size, and then the leverage number goes below the contract size if you were going to divide it. So if we were to buy 100,000 contracts on 10x, we would divide that by 10, right? So it costs 10,000. Is that right? No? Yeah, that's right, math. I don't think it's an insult, because a lot of newer market participants have no idea what a derivative is. So anyways, so margin is going to be the BTC value assigned for that trader being traded. And whenever we'll go into that here shortly. Based on our leverage, we get a liquidation price. So as I was saying earlier, the risk of engaging, in BitMEX and CFDs or short selling is there's going to be a liquidation. Once you enter that trade, there's a liquidation price that's set, and if the asset's price drops below your liquidation price or your true liquidation price, you're going to lose everything assigned in that margin, right? So your risk is going to be the assigned margin, and that's why we never want to go all in. And we'll talk about position sizing a little later. Contract types, there's a perpetual, which charges interest every 8 hours, right? This thing is for very short-term moves. There's the up month 15, down month 15th. I stay away from these. This is us betting against the BitMEX engine, and I don't trust BitMEX or their engine. So these two contracts I stay away from, right? Lately, what's been the most profitable for us have been the longer term, the U18 and the M18. Currently, there's a June 29th that's been available for trading for a little over a month now, and there's a September 28th. These don't charge any interest, and they're a long-term contract. And what the advantage is on a longer-term contract versus a perpetual is we're not paying interest every 8 hours. Watchman and myself and a few others have been into... That's a great point. I'm going to highlight what you just said, Watchman. So short selling in crypto, short selling on BitMEX, there's no margin call, right? A liquidation price ensures that nobody's going to call you and say, hey, you owe us, we're going to sue you, we're taking your house because you made a bad trade. What a liquidation does is it ensures that never happens, and instead the assigned margin is liquidated by the exchange. Instead of the exchange calling you, say it's margin call, you need a cover. Great point, Watchman. Thank you. Moving into, okay, so these are the contract types, right? I'm going to real quickly hop on to BitMEX testnet, show you guys where all these contracts are. This is the testnet. I can't BitMEX without VPN, so we have to be on the testnet for now. There's a perpetual, which is up here. So once you log in, there's Bitcoin, there's perpetual, there's the up and the down, June 15th or monthly 15th. And then we've got the June 29th and the September 28th. And essentially we want to play these two contracts against each other when we're hedging. So if we're long on September, we want to short June or vice versa. Now, if we do see an incoming really short-term move that's worth paying interest on every 8 hours, we can play the perpetual, which is all the way up here. We don't want to do that. Ideally, we want to stick to the longer-term contracts. We can keep them open, not get charged. I do have that, yeah. I can shrink it down. Can be. No, testnet's not going to get the same volume as the normal chart. Obviously, right, it's not going to look the same. But I can stream and do this without being on VPN, or else the stream quality is going to suck. So for you guys that haven't seen the MEX interface before, when I was talking about leverage, I'm going to go ahead and show you how to leverage your trades up and where to get that liquidation price. So this is going to be the contract quantity. We do have a BitMEX tutorial. I'm not going to dive into this too much because we've covered this material, and it's in the trading library resources, right? And then so we've got, this is going to be the price. You can do a limit buy, market buy, and a stop. And to leverage the trade and get that discount on the trade, this is our margin slider. So whether we want to leverage up at 5x, 3x, 25x, we'd apply that here, place the buy long or short, and then here we're getting was at position size after execution 1,000 for very little XBT, like minimal XBT on that, and that's going to be at 25x. And what that's going to do, whatever X leverage we go in at for every 1% the chart makes, we would get that 1 times the leverage equal percent gain on that margin position. So when to hedge, right? Hedging is best employed at a market turning point. So bearish divergences, and I'll cover that when we go over the chart here next. Reversal formations, FUD, right? That Binance hack, we saw BTC. That was the last round of real FUD we saw. We saw BTC really take like a $600-700 hit in one day, and actually dropped. It just kept trickling down over the next 4 or 5 days. So if there's a decent amount of FUD, we catch an article early on, we know there's going to be a drop. Maybe open a perpetual or start hedging against the long. If one does not have a short open and they're heavily in the alts, it's a good idea to start deploying a short when there's a round of FUD. So earlier last year, late last year, when we had the Korean exchanges being raided, that caused a massive sell-off. So FUD, and then as well as technicals, and that's what we basically trade on here, right? At Generation Crypto, we're mainly technical traders. My typical portfolio allocation, I'll do 40% in momentum, 20% in fundamental longs. I keep 20% liquid, and I get 20% for hedging and leveraging trades. And as this pot grows, like lately, after we had the last alt rally that we made, those gains off Poly, ZRX, BAT, Lumens, we made all those gains. So this portion of the portfolio grew, and then from there I reallocate and spread them out. This would be in a typical bull market. Right now, my portfolio does not look exactly like this. I'm exiting some of like ADA's divergence last week, early last week when I got out of ADA, right? So that's back into liquid. So I'm essentially, whatever makes a new high that's divergent, I get back into liquid just to reallocate and redistribute myself. All right, now so let's move into the chart, right? Where things are gonna get really interesting. I'm gonna use Coinigy and TradingView. I'm gonna essentially pop back and forth between the two. Now, a lot of us missed this, right? We were stuck in euphoria. Everybody was just really excited. We couldn't believe BTC was at 19,000. But if you look on the chart, almost every time frame was divergent and highly divergent. This is the 4 hour. We see this new high on a much lower RSI high, hence a bearish divergence. Here comes the correction. Luckily, there was a second rally over here. This is where my portfolio was an all-time high. But that rally itself presented a bearish div. This is a hidden bear divergence, and this is why I had links to the RSI divergences workshop and chart formations workshop in preparation for this one. So I really hope you guys covered those or went back and watched them. Now, so when we see this hidden bear divergence, the best thing to do is to open a short, right? And based on our portfolio size, so if we have a 20% of our actual crypto portfolio ready to deploy, we don't want to use all of it. We want to be able to essentially hedge against that short in case we made a wrong decision, so we don't lose the entire position. So typically when I'm hedging on something like this, on a bearish div on a longer time frame, I'll go 25% of what's available at 25x. It'll give me a few more chances to hedge against my bet if we were to go long to make up for any losses. And it would also give me the ability to short some more in case I needed to. Now, moving down, where things got really interesting, I'm going to go into these last two corrections, right? Came to February low, we had the rally all the way up to 12,000. We did see this bear div. You guys that traded this area with me, this correction, go ahead and highlight it. You guys that traded this correction with me, we made, I think, this was only 13 trades, right? And we longed and shorted this whole thing for 13 trades, and we got 12 out of 13. Zero was with us at that point. Zero shorted here. I shorted too late, right? I had a long open, those and massive gains, and it was really high leverage, and then this drop just was a disaster. But you know, we still made it up. So and what this taught us is that third and fourth divergent high, that's when we really want to start taking up these short positions for hedges. Go ahead and drop some clones. So looking at RSI, based on this last run, here we're on a 4 hour, I'm going to go to a 2 hour, we should see those divergences more clearly. So we did buy back the bottom over here. That's actually in my notes. It's been there for a while. So if you guys scroll back, if you're new to the channel, if you're new to our Discord, you can go through BitMEX long short or Saber notes, and you'll find these positions taken up down here. And here we see that first high make an RSI high. Can you guys see my RSI in purple? Do I need to change colors? Do I need to make it white? This is probably a little better. So Watchmen, I'm gonna tell you, you know, when the best time to, when I think the best time to close a long is here shortly, and when we talk about the stop losses on these trades. So here we see the first high, right, and it's not divergent yet. Then we see the second high. And had we opened a short here saying, hey, I'm not short because this high is divergent, we would have gotten stopped out or liquidated. Here comes the third high, which we'll call it that one since RSI actually did break up into the actual extreme, and we noticed the drop. So this would be the first divergent high, second divergent high, third divergent high. And once we get into the fourth and the fifth, that's when we should really start paying attention. This area right here on the fourth divergent high, then we see this next high still not into the extreme. This entire run from 10K all the way up to 11.7 was divergent. So this was a bull trap, right? Zero was brilliant to short it up here at 100x, and then he told me after this candle blew down, that's when we closed long and started shorting back down. So we really should start building confidence in the short on that third and fourth divergent highs. I think the second divergent high is going to be too soon. So as to when to open a short or when to start hedging, if one didn't have a long open and we see the market starting to do this, starting to be divergent because everything is being traded on a BTC value, and it seems to be as BTC does these corrections, we're going to see our portfolios take hits in USD values. The best way to hedge against it is to open a short, whether it's at 10x or 25x or even 5x if you don't want to take on a whole lot of risk. So this entire rundown is profitable. Now opening this short on a perpetual would have been really expensive to hold it all the way down to the next bull div. So this entire run went on for 13 days, 13 divide. That's a lot of interest to pay off, right? So we don't want to open up hedges on a perpetual short. I don't think that's the best idea. I think it's a terrible idea, actually. Now, Watchman, at what point, does a long no longer be valid, right? Let's say we opened a long down here, which is where I signaled that long, and we're up 24%, right, at 25x. So that's quite a bit. Personally, I would rather keep my long open at a stop loss below this range, right? At the last fractal. Where did the market turn last? It would be at that last fractal. So I would much rather put a stop loss on my long, right? And open my short. Because if we do get a bounce at this support level, then essentially I didn't make the most out of my long. I'd rather make 18% times 25, right, and then compensate for that drop come my short, because I'm going to be in the profits regardless. We're allowing a little bit of error in our call, right? But that error is going to be corrected with the short. This is where the hedge comes into play, because our long is no longer profitable on the way down, but our hedge is making up for it. So once that long is exited at that 18%, now the short is becoming profitable on the way down, because it's going to be really hard getting out at the top, but figuring out how much of a percent error, if you want to call it that, off the top we're willing to assume, right, and a means of risk on realized gains, or almost unrealized gains. How much of a risk do we want to take on, and how are we going to offset it? So if we're offsetting it with a hedge, we're not really losing anything. We just protected those gains by opening up a short of equal value. They're only losses if they're open at the same time. But if we were to short up here and long all the way from down here all the way up, these losses in the long are gains in the short. There we go. Camby just nailed it. Okay, awesome. Now let's fast forward a bit. Bitcoin gone halal candle. You guys remember this one? A few days before that. Exactly. So when there's uncertainty, we've got a long open, and it's best to hedge against it. And my favorite scenario is going to be right here, where we saw this run, right? When these two highs were divergent. And I'll go into that a little later, where we had a long open from 79, right? And we ran all the way up to 85, and then there was that big massive drop, and I saw this wedge. I said, hey, this thing's going to be a really good run. When we saw a divergence, I was like, hey guys, we've got two divergent tops. I recommend hedging a short, right? So even if that long got closed out at a stop loss in the profits, we're still profiting on the short the whole run down. The idea is going to be capturing the bigger swings, capturing the 25, 50, 18% swing in normal terms on 25x, 10x, 50, 50x. I'll talk about when to close the positions when we see a divergence next. I'll cover that. You want me to cover that now? All right, thank you. So next up is the Bitcoin gone hello. Here, when I saw this big massive wedge happening on a linear chart, I posted about it, and then we saw this upwards break. This was probably the most profitable margin trade we've done in quite some time. This was when I was still back in Dallas, and we had the wedge break. We picked up the retest of the wedge. A little bit of gain here. There was the steep drop, right? The liquidation run before the Bitcoin halal candle. And here I think BTC made a 50% move. 48%. So we had a 48, 49% gain, right, from a long. Let's bring the RSI in and see what RSI was doing. This is where the third and fourth divergent highs really start coming into play. So the 25% move on 25x, amazing gain. We see this massive run up. RSI slightly higher than previous one, but this is our second, maybe a hidden bear div. Third high, what happened? We had a pullback, right? We see these tweezer tops on a 4-hour. This is a 2-hour. Tweezer tops on a 2-hour, friction with the upper band. This is normal for a pullback. We see tweezer tops and we see friction with the upper band. Let me go back to a 4-hour, and I don't think this run was divergent on a 4-hour. So our 4-hour chart, new high, new RSI high, no divergence. We're still good to go on a long. Now, if we saw this drop based on your question, Watchman, would you have closed your long based on this drop because we see the pullback happen? Or would you have hedged a short? That's where there's that uncertainty where we want to keep, see? Hedge a short. Where would you hedge a short? What's the short signal? We still have a new high. We have a new RSI high. We don't have divergence yet. We're still here. We don't see the divergent high. This is what the chart looks like. Right. And that's a little more trading than I'd like us to be doing. I'd like myself to be doing. I essentially want to catch the bigger swings, right, with a decent stop. And which time frame is going to be more accurate? Can be a 4-hour or a 2-hour. If we have a 2-month future open, if you had a June future open or April, most likely the 4-hour. There we go. So long is still open. Long is still open. A candlestick trader would have seen this with the on the upper side of the band they'd see the tweezer tops, they would have shorted here. And then they would have had a couple of chances to close out. So this would have been a proper hedge on the 4 hour based on the bands, right? If you wanted to maximize our opportunities, and we see the price above the Bollinger Bands, we see those tweezer tops happening. This would have been a viable hedge based on these two indicators: tweezer tops and friction with their close and open, and close and then an open above the top of the bands. That is due for a retracement, but then we see the market make a higher low. We definitely want to close out in this scenario when we see the breakout continuing. Now, moving on, what happens next? We've got a similar high on a much lower RSI. So this would be the second high, or first high. We got our second high on a lower RSI, third and fourth. I'll zoom in. This is still a 4 hour chart, right? So you've got 1, 2, 3, even up here. You know, we're still divergent because price is forming a new high when RSI is even failing to break out of that extreme. Even on these two, on the tip of that run, clear divergence. And what else? What's this reversal formation? Rising wedge and a bear div. I posted this. I said, hey guys, and this is also in my notes, 5.5, 5.6. There's a bear div. I'd recommend opening a short, hedge your portfolio, right? Market came out of a 50% rally. We got these divergent highs. This is a good time to open a longer or a larger position hedge in a sense of 20% of that BitMEX portfolio, 15% at that BitMEX portfolio at 25x. So it'll compensate for the drop. And you know, if you're in alts and alts start losing, tying up stop losses and still be profitable in this drop. Now this drop retraced all the way back to zero. That's a 50% drop at 25x, and here we are starting a rally again. Back to that falling wedge I was talking about. Where was this last wedge, Watchman? Crap. You guys remember this wedge? This is where we'd absolutely exit long. Up here, Watchmen, absolutely exit long. The hedge comes in, hedging the portfolio, right? So if we have 60% in alts and we're bagging these alts and we know the market's going to come down, we have a couple of options: open a short or exit alts, or we can do both. We can exit alts and open a short, and that's what we're hedging. Whatever BTC, now we're hedging the portfolio in a sense of overall portfolio versus just our BitMEX holdings for a trade. This is where the hedge comes in. So we're doing two things. We're protecting the overall portfolio value, and we are yeah, absolutely. That was a clear exit signal. I agree with you. The hedge comes in whenever we are taking into account if somebody did not have a long open, they're bagging a bunch of alts, they don't exit alts. That's a good time to hedge, because remember, not everybody's just a BitMEXer. A lot of people have bigger altcoin bags. My altcoin portfolio is typically 4x my hedging and margin trading portfolio. There we go. That's what we're talking about. This is why I'm doing this workshop, right? Because a lot of people get stuck in these alts and a market downturn. They say, "Hey, I don't want to sell. I'm gonna hodl. This is a good coin. Fundamentals are good. I don't know how to read charts. This is the time to hedge the entire portfolio." Now you guys get it. This is why we're doing this workshop. Now let's stay in tune here, right? We went long on this wedge, and this is a 4-hour chart. I'm gonna go to 1 hour. Oh, I lost it. There we go. So we went long here. I said, hey guys, I think I see another falling wedge. This could be the next reversal setup for a massive leg up, right? This last falling wedge made 50%. This next one could be a high profit, there's a high probability of really good profitability on this wedge. Our last wedge did us really well. So we went long. What happened shortly afterwards? We didn't see a rising wedge. We didn't see a head and shoulders, or did we? The main indication here was these divergent highs, right? And there's two divergent highs. And we see these two tweezer tops, not even at the top of the band, and that's when that sell-off started. On the second divergent high, which wasn't my typical third or fourth, I also mentioned, hey guys, this is probably a good time to hedge a short against our long. I know a lot of the margin traders in our chat had some really big positions because last wedge worked out so well, and this is where position sizing is gonna play a role. So if you've got a big margin position, let's call it 20% of the margin trading portfolio, we want to have another equal size position to counter it on a hedge, right? And we want to be able to be wrong more than once. We want to get liquidated. So you guys know I typically only long reversal formations or bullish divergences, right? Especially on margin. So I have to have a strong formation so I don't get liquidated right away. And same thing on a short. We don't want to get licked right away. And I'll cover stop losses next. So opening up a short here, and even if we close this long at a tiny percent gain, there's no fractal here, and I'll go over, setting the stop on a divergence. We were still covered in this downside. Who all shorted? Who all shorted up here? Can be. Did you short? Watchman, did you short that top? Goldilocks? I know a few of the guys shorted. Awesome. So, hedging short, even though we had a really promising long, and it was up 5-6%. We thought that was the beginning of the run. What did the market do? The market turned around and it still headed down. So this was a fake rally. It was essentially a bull trap, and the market is still making lower lows from that last wedge, right? So opening up that short up here on a September future, even a June 29, and keeping that open, today would have been a great payday, right? A negative 22% at 25x, that would have been a great payday. So had one even set a stop loss on that long at entry and just hedge their bet with a short, say, hey, you know what, I'm not gonna risk, no risk, no gain. I'm not gonna risk any percent loss on this long. So if it comes back to my entry, I'm out. Had they hedged a short when we saw that divergence, we talked about it and I announced it, they would still be in the profits. And this is why hedging works really well, because no matter what the market's doing, whichever direction we go, we're able to be profitable so long as we keep an eye on the market and so long as we act swiftly when it's feasible. Awesome. Perfect chaos. That's what I'm talking about. This is why I'm doing this workshop now, right? Because we're going to see this. This hasn't been a smooth ride up this year, and I don't think it's going to be. I think it's going to be quite a bit of chop before we see the next bull run or the next massive bull market like we saw last year. Now, it seems like there's a lot of these wedges, and they are reversal formations, but they haven't been as fruitful as this massive wedge. So we had another wedge break up, and we were just long a few days ago, and Friday I was saying, hey guys, we're gonna be at a turning point. We're gonna have a 12-hour moving average cross. If BTC can go sideways to that MA cross and moving averages break up, it's gonna be nice. But there was gonna be room for volatility either way if the moving averages fail. What happened? Price action didn't even make it to the MA cross, and I can pull those MAs on Coinigy. Don't want to get rid of this. I'll pull those a little later. Don't want to get rid of what I've got here. And in the chat, we were saying, hey, this is not looking too promising. I didn't signal a short, but also said I'm neutral. Goldilocks said there's a head and shoulders. Some of you guys shorted here. Who all shorted? Who all shorted Saturday? Friday, Saturday. $7,700. Can be. That's awesome. Remember we were talking about that 77.13. What did I say? I said, hey guys, I'm seeing a somewhat of a divergence, and we saw this divergence play out over here, right? This was a divergent run. This was a divergent run, and we saw RSI somewhat do of a bullish div, but it didn't quite play out. Price action wasn't aggressive enough. I think on the 30-minute is where we saw the divergence start playing out. And this is where it was. It was a 30-minute divergence. And I said, hey, we're divergent on the 30. This might be a time to start picking up these shorts. I did say second or third divergent high. This was a higher high. RSI still lower. Higher high. RSI still not even in the extreme. So that's 77 from Can B. Beautiful entry all the way down. Nice, good job, perfect chaos. So you guys are getting in. You guys get it. In concept, the idea of a hedge is so we don't exit our long too soon. And so we can protect our portfolio as far as altcoins go, because had we closed our long here on this high, we wouldn't have been quite as profitable. So we want to start securing and hedging shorts on the next highs that are clearly divergent. And we want to forget the scalping mentality, because that's how everybody gets wrecked. Right, so we don't want to worry about these little intraday moves when we're margin trading. We want to get in it at some of these lows, right, and really hedge the second, third, fourth divergent highs. And I'll cover stops next. I think stops are next. Now, what's happening today? If you guys look through my notes, I did post a diamond. There's quite a couple of formations happening, and I posted the diamond. I'll go into smaller time frames. So I said there's a symmetrical triangle. Symmetrical triangle that typically means continuation, but instead we had a breakout. It failed to sustain. We formed a diamond. We had a downwards attempted break of the diamond, and I did say, hey guys, towards the apex of the diamond, we're going to see volatility come in. And the volatility went to the upside, and then I posted, we're going to see a retest of the diamond. Didn't quite get down there. So where that fractal is, right above it, price action even above the fractal, but now we're up. Last night, we were seeing bullish divergences. I said, pick up the next oversold. I picked up, not quite oversold, but I had another buy order at 66.20. I had a 66.70 order in at 50x and a 66.20 order at 50x. And I'm still going to let this one ride until I see a bearish divergence, right? With a stop, and this is where stops come in. Typically, whatever time frame we enter a trade on, right, whether it's a long or a short, and we want to hedge against it, I like reverting back to a 4-hour time frame and Williams fractals. I do like the setup of Williams fractals on Coinigy better than I do on TradingView, just because they're a lot closer to the candle. There's a lot few of them. My typical fractal setup is going to be two period fractal. I've set these up in the Ichi workshop, right? We're still using the same fractals. Now back to buying. This is a log. This is not log. Back to entering this trade. We see the market go into a breakout, make a high. We see the tweezer tops come in, and then we see the pullback. What does the market do? It achieves a higher low. Fractal is above the previous one. You guys can see my fractal, the green dot. I can make them bigger. Maybe I can't. Fair enough. So once the market tests this low and then goes up, makes a newer low that's higher, and heads back up, we can start trailing that stop on our long to the next fractal. So now our long's in the profit, right? So you got a profitable long, and it went from 29% all the way up to 31%. This is at 25x. So it's another 75% that we're gaining. Market makes a new high. Highs divergent, right? We could have opened that short here, closed out on this divergence, but where was the really big short that we played? The really big short was right here. So we play this short. We've got so many fractals we can set as a stop loss for our long. Personally, I would go with the last low. I wouldn't want the market to close below this price, because breaking below this fractal, we're essentially making a new low. And this is why I really like setting these stops at fractals, because that's where the market ends up going back to for a retest, right? So it's retesting it on a downwards breakout after having tested it going up twice. So had one not closed their long on the rising wedge that was divergent, can we add RSI? Massive divergence. So even, Watchmen, you would have made 50% on the way up, right? And you would have made 50% on the way down at 25x. So when it comes to setting the stops on these margin trades, I'm definitely picking fractals. And if we were to try to set a stop on this last short, let's say we short one of these higher wicks, where would our stop be? We would simply backtrack or even go to a higher time frame. Well, the next fractal is going to be a little higher than that Bollinger Band. So the next stop up is going to be the next fractal, even if we're going back months in time. This would be, I do. The thing about fractals is, Watchmen, they're going to be further away from the price action. A wick is going to be where the price action went into the extreme. If we go a fractal back, price action doesn't actually get to the fractal, right? It didn't. Fractals are set above the actual bars. And if you go off of one-day fractals, there's not a one-day fractal up until even higher at 10,200. Right? So going off a one-day fractal saying, hey, I really don't want to get liquidated. What was the entry? Let's say we caught the top of the wick. Our entry would have been 99.70 and the stop would have been 10,100. So it's like a $300 margin for error, $200 margin for error that we're giving ourselves on some of these trades. But even on the downside, to the downside, it's the same thing. So whenever we've got these longs in, if we see a bearish divergence, what am I going to do? If I see a bearish divergence coming up on any time frame, I'm going to look for the third high, second high, start hedging my short against my long. and whether I want to be profitable on my long, get out at flat even, or depends how much risk I'm willing to take. Depends how much risk every individual trader is willing to take. We're not going to catch every single move. The fact that we've got a short hedge, it's going to guarantee that however far we drop against that long, we're at net zero. But at some point, one of these trades has to give. Now, looking at this thing on the daily, we're price drop far below the Bollinger Bands, right? And we had this diamond happen, starting to shape back up. I'll do a BTC update tomorrow. Kind of want us to get more market direction out of here. Now, I think 6,300 is going to be below my liquidation because I'm at 50x. So I'd want to look at the 4-hour fractals, see what's happening in a 4-hour time frame, where the next low is, and here there's a few of them. Quite a few fractals, right? There's all this range. So when it comes to setting these stops, I'm going based off fractals, and that's what I believe the best way to do this is, because fractals is going to be a little further away from where the price action is. How do you guys feel about this? Let me see if I forgot to cover anything. So we talked about profiting in a downtrend, protecting portfolio in long-term downtrends. We talked about trading the big swings, right? Setting proper stops on longs and shorts, when to hedge, and position sizing. So this is the stuff that I said we would talk about. Awesome. Glad you guys enjoyed it. I'll hang tight, see if anybody's got more questions. Sorry about the muffled audio earlier. Yeah, thank you guys for tuning in. I'm gonna do a power hour market update. Ooh, MA cross, that's right. We're on a 12-hour time frame. And let me put my MAs on here. This is where we was Friday, the 7th? No, that was the 8th. This is where we were Friday, and I said, hey, we're going to come up on this moving average convergence area. If moving averages break above, then we're going to see upwards volatility. But what happened? They did not break above. We saw these massive sell-off candles. And I'm thinking this is a capitulation run, right? The problem is, we're used to these prices, so not very many people are going to capitulate at 6K anymore. So it's a 50-50. From here, are we going to go up, or are we going to go down? Where we cherry picked the bottom of the diamond and BitMEX long short, right? We picked up the diamond. We're making gains up until we see a divergence. We're still long. Maybe we might hedge a short against it. If we see a rising wedge or head and shoulders or reversal pattern or a FUD, we'll get our exits. Anyways, guys, thank you for tuning into this workshop. This is a topic I've been wanting to cover, right? It's going to make everybody a better trader. It's going to make everybody a better market participant. So if you guys watch this, thank you. And, let me know thoughts on how I can improve these workshops and what you guys want me to cover next. I figured cover this one because every one of you guys can use this. You bet can be. Thanks all of you guys. Thank you for tuning in, and gals.